Okay, I am going to take just a couple minutes here and share with you a little bit more about overhead and particularly over and under applied. So what I'm going to do here is pull up our whiteboard and we'll see if we can make sense of this. All right. So like I've done before, and I talk about this big, huge overhead bucket, here's my bucket. And anytime we have things going in to this bucket of overhead, anything going into overhead, which would be a debit, okay, that would be a debit, that is actual. So this side is what we call actual costs. Anything that we take out of the bucket of overhead would be, of course, a credit, and that's where we are applying overhead, okay? So for instance, let's say we paid for the real estate taxes. And those real estate taxes, of course, are for the factory. So when we pay it, it's going to be a debit to overhead and a credit to cash or AP. And as I've mentioned before, and I'll say it again in this video, whenever you are crediting an AP account or a cash account, that has to be for actual, right? We're not paying the vendor an estimate, we're paying actual. Well, actual would mean then you're going to have to debit your overhead, credit cash, and that is going into the big bucket of overhead or that account overhead. When we start to apply overhead, it is an entry similar to a debit to WIP and a credit to overhead because it's coming out. So credits will be apply, and it's based on that predetermined overhead rate. So on something that's predetermined overhead rate, some predetermined overhead rate, whether it's based on machine hours or labor hours or whatever, but we're going to apply taking it out and putting it to the job on some kind of predetermined overhead rate. Now, when we talk about over and under apply, and how does that happen? Well, if this is the bucket, and let's say, for instance, there was only one item that went in there, and it was for those real estate taxes, and it was 10. Okay, so $10 we paid. And based on our predetermined overhead rate, we applied at 8. Well, in this case, you would say, well, there's a $2 difference, debits versus the credits. We have under applied by 2 because our credits were only 8. We under applied. And in this case, I think that's, we've talked about this before. What would you rather have, an over or an under application? And I would say we would always want to be over applied because that means that we not only took care of all of our expenses, but we did even further. So in this case, the 10 versus the 8, we under applied. There's still a balance of $2 in that account that never got applied. Now let's say it was now we applied 12. Well, in this case, you would say we have an over application of overhead. It's a credit balance, a $2 credit balance, and that's where we would want to error because that means that we not only covered all of our costs, but we covered costs that we, quite frankly, didn't have. And that means we have a credit in what would be typically an expense type of an account. Overhead, right here, right? When we think about overhead, overhead is something that's going to be capitalized as an inventory item, right? There's 3 items in for a cost: raw materials, direct labor, and overhead. But eventually, we sell this inventory item. And what's that entry? It's a debit to cost of goods sold and a credit to inventory. So that credit to inventory is those 3 costs: direct materials, direct labor, and overhead. Now, in this case, there's a $2 over application. So we have a $2 credit sitting in our overhead. Well, at the end of the year, how do you got to zero out this account because we can't let this account continue to grow. And this is going to happen, and that's fine. Well, if there's a $2 credit in there, we have to get rid of it. So we will debit overhead, right? Debit overhead by 2. And what we're going to do is we're going to credit cost of goods sold for 2. So in essence, we are creating a credit in a normal debit expense category. So what is that? It's almost like revenue. It's not revenue, but it's a credit, so it's like revenue. On the flip side, if this was back to our example of 8 again, then what would we have to do? Well, we would have to credit overhead. Let me erase some of this. We'd have to credit overhead and debit now cost of goods sold, because there is, if there was 8 in here, okay, if there was 8 in here, that means we didn't apply enough. So we would have to put another $2 there just to wipe it out, and then a debit to cost of goods sold, which means there's more expense, more cost of goods sold, and certainly there's no sales for that $2. That's just expense that we didn't apply. Okay, so really, what you got to get out of all of this is, when we look at overhead, we need to know that as far as this bucket is concerned, anything going in is actual, anything going out is applied. And based upon what comes in and what goes out is going to create that under or over. And hopefully by the end of the year, it's a very minimal amount and we don't need to worry about it. That pretty much takes care of my additional lecture on overhead. So I'm going to stop sharing this. We'll go back to my desktop. If there's anything else that you need help with regards to this, please let me know.